With the ever-changing economic landscape, it's crucial to stay ahead of the game. So whether you're planning to save, invest, or just be more mindful of your spending, stick around because I've got some powerful tips for you that can set you up for financial success in the upcoming year. As we approach 2025, it's essential to understand the financial landscape that will shape our economic environment. Experts predict that inflation will continue to be a significant factor, influencing purchasing power and overall economic stability. This means prices for goods and services may rise, affecting your budget and spending habits. In addition, interest rates are expected to fluctuate in response to economic policies and market conditions. Higher interest rates could impact borrowing costs, making mortgages, car loans, and credit cards more expensive. Therefore, it will be critical to keep an eye on interest trends and adjust your financial strategies accordingly. Moreover, technological advancements are changing how we interact with money. Digital currencies are gaining traction, and online banking is constantly evolving, offering new tools for managing finances. It's important to familiarize yourself with these digital innovations, as they can provide easier access to your funds and enhance your investment options. Furthermore, the role of personal financial management apps is becoming increasingly significant. These tools can help you analyze spending patterns, create budgets, and even invest smartly, all from the convenience of your smartphone. Embracing technology and ensuring you are up to date on the latest financial tools will be paramount in 2025. Ultimately, being proactive about your financial education will not only prepare you for the challenges of 2025, but also empower you to make informed decisions. So when considering your financial habits for the upcoming year, always keep the macroeconomic factors in mind. By staying informed and adaptable, you'll be better equipped to navigate the financial waters ahead. Moving on to our second habit, reviewing your financial goals. As we step into 2025, it's crucial to take a step back and evaluate what you want to achieve financially. Setting clear and specific goals is the foundation of effective financial planning. But remember, goals aren't static. They should evolve as your circumstances change and as you gain new insights. Start by identifying what financial milestones matter most to you. Are you aiming to purchase a home, save for a vacation, or perhaps build a retirement nest egg? Different goals may require different approaches, so categorize them into short-term, medium-term, and long-term objectives. Short-term goals might include saving for a trip or an emergency fund, while your medium-term goals could involve paying off debt or saving for a significant purchase. Long-term goals often encompass retirement planning or investing in your children's education. Clearly defining these goals will give you direction and motivation as you work toward your financial future. Once you've clarified your goals, it's essential to write them down. Research shows that individuals who write down their goals are significantly more likely to achieve them. Writing down your goals not only commits them to memory, but also helps you visualize your aspirations and keeps them on top of your mind. Next, create a plan of action. Break down each goal into actionable steps. For instance, if your goal is to save for a home, determine how much you need to save and by when. Set specific deadlines and establish a monthly savings target. You can utilize budgeting tools and apps to track your progress and hold yourself accountable. Additionally, don't forget to review your goals regularly, at least once a quarter. Life is unpredictable, and your financial priorities may shift due to job changes, family growth, or unexpected expenses. Adjust your goals to reflect these changes. Ask yourself questions like, are these goals still relevant? Do I have the resources to achieve them? Have my financial priorities changed? This ongoing assessment will keep you aligned with your financial aspirations and ensure you remain motivated. Finally, celebrate your achievements, no matter how small. Acknowledging your progress can be a powerful motivator to keep pushing toward your financial goals. By making it a habit to review and refine your financial goals regularly, you'll put yourself on a clear path to success and resilience in the evolving financial landscape of 2025. Remember, being proactive and adaptable in adjusting your goals is key to long-term financial health. Now let's dive into our third habit, building a budget and sticking to it. Creating a budget may sound tedious, but it's one of the most powerful tools you can have in your financial arsenal as you approach 2025. A well-structured budget serves as a roadmap for your spending and savings, guiding you toward your financial goals while also helping you recognize and reduce wasteful expenses. Start by tallying your total income. This means considering all sources of income, your salary, side hustles, investments, and any passive income streams. It's important to have a clear picture of what money is coming in each month. Next, record your fixed and variable expenses. Fixed expenses are those that stay the same each month, such as rent or mortgage payments, insurance premiums, and subscriptions. On the other hand, variable expenses can fluctuate, such as groceries, entertainment, and dining out. Tracking these expenses accurately will allow you to see where your money's going. Once you've outlined your income and expenses, it's time to allocate your funds. A popular method is the 50-30-20 rule. 50% of your income should go toward needs like housing and utilities, 30% to wants such as entertainment and hobbies, and 20% to savings and debt repayment. However, feel free to adjust these percentages based on your unique financial situation. Now comes the crucial part, sticking to your budget. One of the best ways to ensure you stay on track is to use budgeting apps or spreadsheets that keep real-time tabs on your financial activities. Many apps can send you alerts when you're nearing your budget limits, making it easier to resist impulse purchases. Also, establish a specific day each month to review your budget. This could be at the end of the month or the start of a new one. During your review, compare your actual income and expenses to what you had planned. Are you overspending in certain categories? Are you saving enough? Use this insight to adjust your budget and spending habits accordingly. Moreover, consider setting spending limits for discretionary categories. Think dining out or entertainment. By setting boundaries, you can enjoy your favorite activities without derailing your financial goals. Remember, budgeting isn't about depriving yourself. It's about managing your resources effectively to achieve what you want. Allow some flexibility in your budget for occasional splurges. This will help you stay motivated and engaged with your financial plan. Lastly, keep in mind that a budget is a living document. As your life circumstances change, whether due to a job change, moving to a new city, or having a family, your budget will need to adapt as well. Embrace these changes and revise your budget as needed. By making budgeting a habitual part of your financial routine, you'll gain greater control over your finances. This practice will ultimately lead to peace of mind, allowing you to navigate the complexities of 2025 with confidence and security. Remember, successful budgeting is not just about numbers, it's about making choices that align with your values and goals. Let's discuss an essential habit: establishing an emergency fund. Having a financial safety net is not just a good idea, it's a fundamental building block of financial security. An emergency fund is designed to cover unexpected expenses, such as medical bills, car repairs, or job loss. Without this cushion, you may find yourself relying on credit cards or loans in times of crisis, leading to higher debt and financial stress. So, how much should you aim to save? Financial experts recommend building an emergency fund that covers 3 to 6 months' worth of living expenses. This estimate allows you to manage your essential costs. Think housing, utilities, food, and transportation, while you navigate unexpected events. To get started, assess your monthly expenses to determine how much you ideally need in your emergency fund. Once you've set a target, the next step is to set aside money consistently. Begin by allocating a portion of your income each month specifically for your emergency fund. Treat this contribution like any other priority expense, because it truly is. If saving a lump sum feels daunting, don't worry, start small. Even setting aside $50 or $100 per month can add up over time. The key is consistency and commitment. You can also consider automating these contributions by setting up a dedicated savings account and scheduling automatic transfers from your checking to your savings. Out of sight, out of mind. This way, you won't be tempted to spend the money you've earmarked for emergencies. Additionally, it's crucial to choose the right account for your emergency fund. Look for high-yield savings accounts or money market accounts that offer better interest rates than traditional savings accounts. This way, your emergency fund not only acts as a safety net, but grows slightly over time, increasing your financial security. As you build your fund, remember that the purpose of this savings is strictly for emergencies. It should not be used for planned expenses like vacations or major purchases. Keep your emergency fund separate and easily accessible. Make sure you can access it quickly without penalties, which is vital when unexpected situations arise. It's also a good idea to review your emergency fund periodically. As your life circumstances change, so will your financial needs. If you get a new job, move to a more expensive area, or have a child, you may need to adjust your emergency fund target accordingly. Finally, remember that life will always throw surprises your way. Building an emergency fund equips you with the confidence to face those challenges without derailing your long-term financial plan. When you have a safety net in place, you can make decisions that align with your values without being paralyzed by fear of financial insecurity. As you prepare for 2025, make establishing an emergency fund a cornerstone of your financial strategy. It's a simple yet effective way to safeguard your financial future, allowing you to navigate life's uncertainties with resilience and peace of mind. By prioritizing this habit, you're investing in your stability, ensuring that you have the resources you need when life doesn't go as planned. Let's move on to our fifth habit, making investing a priority. In today's fast-paced and ever-changing financial landscape, it is essential to ensure that your money works for you. Investing can be one of the most effective ways to build wealth over time, especially as we look ahead to 2025. The sooner you start investing, the greater the potential for compounding interest to work in your favor. First, it's important to understand the different investment options available to you. Traditional avenues such as stocks and bonds are still relevant, but there are also a host of alternative investments, including real estate, mutual funds, exchange-traded funds, ETFs, and even cryptocurrencies. Each type of investment has its risk profile and potential return, so take the time to educate yourself about what these options entail. If you're new to investing, consider starting with a diversified portfolio. This means spreading your investments across different asset classes and sectors to minimize risk. Diversification can help cushion your portfolio against the volatility of any single investment. Remember, the market will have its ups and downs, and diversifying your investments can provide a measure of stability. One approach to consider is dollar-cost averaging, where you invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps mitigate the effects of volatility and can lead to a more favorable average purchase price over time. It's a great way to stay committed to investing without trying to time the market, which can be risky and often leads to missed opportunities. As you consider your investment goals, ask yourself what you're investing for. Are you saving for retirement, a home, your child's education, or wealth building? Clearly defining your goals will help you choose the right investment strategy and time horizon. For long-term goals, such as retirement, you may be able to afford more risk as you have time to recover from market fluctuations. Speaking of retirement, if you haven't already, open a retirement account like a 401k or an IRA. Many employers offer matching contributions for 401k accounts, which is essentially free money. Take advantage of this benefit by contributing enough to get the full match. If you can, prioritize maxing out contributions to your retirement accounts. These accounts often provide tax advantages that can significantly enhance your overall returns. However, be cautious and do your research before making any investment decisions. Understanding the risks involved is crucial. Avoid jumping into investments that you don't fully understand, and steer clear of get-rich-quick schemes that promise extraordinary returns with little risk. Investing is a long-term game, and patience is often rewarded. Another vital aspect of investing is reviewing your portfolio regularly. Life changes, financial markets evolve, and your goals may shift. Schedule regular check-ins, perhaps every 6 months or annually, to review your investment performance and make adjustments as necessary. This practice can help keep your portfolio aligned with your goals and risk tolerance. Lastly, consider seeking guidance from financial advisors or investment professionals, especially if you feel unsure about your investment choices. A competent advisor can offer personalized advice and help create a balanced investment strategy that fits your unique situation. By making investing a priority, you are taking proactive steps toward your financial future. The key is to start as soon as possible, stay informed, and be consistent in your investing habits. Remember, every investment, no matter how small, brings you one step closer to achieving your long-term financial goals. As we move into 2025, embrace the opportunity to grow your wealth and ensure that your money is working hard for you. Next up, let's talk about the sixth habit, prioritizing financial literacy. In an increasingly complex financial world, being financially literate isn't just an advantage, it's a necessity. The more you understand personal finance concepts, the better equipped you will be to make informed decisions that will positively impact your financial well-being in 2025 and beyond. Financial literacy involves understanding a variety of topics, including budgeting, saving, investing, credit management, and retirement planning. Each of these components plays a crucial role in shaping your financial future, and having a solid grasp of these concepts can empower you to take control of your financial life. Start by seeking out educational resources that resonate with your learning style. There are countless books, podcasts, webinars, and online courses available that cover a wide range of financial topics. For instance, books like Rich Dad, Poor Dad by Robert Kiyosaki or The Total Money Makeover by Dave Ramsey provide foundational knowledge and practical advice. Podcasts like The Dave Ramsey Show or the Bigger Pockets podcast offer insights from experts and real-life success stories that can inspire and educate. Additionally, consider enrolling in financial education courses at local community colleges or through online platforms like Coursera or Udemy. Many of these courses are designed to teach you about investing strategies, retirement planning, and building wealth over time. Choose courses that align with your current knowledge level and financial goals. One important area of financial literacy is understanding credit. Your credit score plays a vital role not only in your ability to borrow money, but also in the interest rates you receive. Educating yourself about how credit scores work, how to build and maintain good credit, and how to manage debt responsibly can save you thousands of dollars in the long run. Regularly checking your credit report can help you catch inaccuracies early on and take steps to improve your score. Furthermore, learning about taxes can empower you to make better financial decisions throughout the year. Understanding tax brackets, deductions, credits, and the importance of tax-advantaged accounts such as IRAs and 401ks can help you maximize your savings and minimize your tax liability. Once you have a solid foundation of knowledge, consider applying what you've learned by creating a financial plan. This personal plan should encompass your short-term and long-term financial goals, alongside actionable steps to achieve them. Setting specific, measurable, achievable, relevant, and time-bound SMART goals will provide clarity and direction for your financial journey. Financial literacy is also about staying informed about economic trends and changes in financial regulations that could impact your finances. Follow reputable news sources, financial blogs, or even YouTube channels that specialize in personal finance topics. By regularly consuming updated information, you can adapt your strategies to fit the changing landscape. Moreover, don't underestimate the power of the community. Join financial literacy groups or forums, either online or in person, where you can engage with other individuals interested in improving their financial knowledge. These platforms can provide support, answer questions, and share insights that can further enhance your understanding. Lastly, remember that financial literacy is a continuous journey. The financial world is always evolving, and what you learn today may need to be adjusted based on new information or changes in your life circumstances. By making financial literacy a priority, you'll empower yourself to take control of your financial destiny. The skills and knowledge you acquire will not only benefit you, but can also be passed down to future generations, promoting a culture of financial awareness and responsibility. As we head into 2025, commit to enhancing your financial knowledge and watch how it transforms your approach to managing your money for the better. Now let's explore our seventh habit, automating your savings. In a world filled with distractions and temptations to spend, automating your savings can provide a powerful safeguard for your financial goals. It removes the human element of forgetfulness or procrastination from the equation, ensuring consistent progress toward your financial objectives. So what does it mean to automate your savings? Simply put, automation involves setting up your financial systems to move money into your savings or investment accounts automatically, without you having to manually initiate the process each time. This way, savings happen seamlessly, and you don't have to think twice about it. Start by assessing how much money you want to allocate towards savings each month. Whether you're saving for a vacation, an emergency fund, a down payment on a house, or retirement, determine a specific amount that you can comfortably set aside without disrupting your daily finances. Once you have a target amount, you can set up automated transfers through your bank. Most banks and credit unions offer options to automate regular transfers from your checking account to your savings account. Choose a specific day of the month for these transfers, perhaps right after you receive your paycheck, so you are prioritizing your savings as soon as your income comes in. Automating savings not only helps you adhere to your saving goals, but can also have a psychological effect. When you make saving a priority right off the bat, you're less likely to view that money as spending money. Think of it as a non-negotiable expense. Just as you would pay your rent or mortgage each month, treat your savings with the same level of importance. You can also leverage employer-sponsored retirement accounts for automation. If your workplace offers a 401k plan or similar investment options, consider enrolling and selecting automatic contributions from your paycheck. This is a prime opportunity, especially if your employer matches contributions. This can significantly boost your retirement savings with little effort on your part and take advantage of compounding interest over time. In addition to simple savings, consider automating your investments as well. Many investment platforms, including robo-advisors, allow you to set up recurring investments. This means you can regularly contribute to your investments, taking advantage of dollar-cost averaging, which helps mitigate market volatility. As you set up these automated systems, regularly review your savings goals and financial situation. Life circumstances can change and your financial needs may evolve, so you might want to increase or decrease the amount you are saving. Therefore, check your accounts periodically to assess your progress and make any needed adjustments. Another tip for automating savings is to create specific savings accounts for particular goals. For instance, you could have separate accounts for your emergency fund, vacation fund, or retirement. This way, you can track your progress and stay motivated as each goal receives its own designated contributions. Finally, it's important to also build some flexibility into your budgeting. While automation helps streamline your savings, you should leave room for adjustments. Life can be unpredictable, and there may be times when you need to temporarily pause contributions or adjust the amounts. Just remember that the goal is to return to your automated saving strategy when things stabilize. By embracing automation, you're not only simplifying the process of saving, but also reinforcing the habit of financial discipline. With automatic savings in place, you're proactively positioning yourself for long-term financial stability. As you approach 2025, make this habit a cornerstone of your financial strategy. The easier you make it to save, the more likely you are to succeed. Start today and let your money work for you while you focus on the things that matter most in your life. Thank you for joining us today as we explored the essential habits that can help you take control of your finances in 2025. Remember, managing your money effectively is not just about making immediate changes. It's about creating sustainable habits that empower you to achieve your financial goals. If you found this video helpful, please give us a thumbs up and don't forget to subscribe for more tips on personal finance, investing, and building a better financial future. We want to hear from you. What habits are you planning to implement in your financial journey? Share your thoughts in the comments below. It helps us build a community where we can learn and grow together. As always, stay motivated, keep learning, and let your money work for you. Until next time, take care and happy saving.